Good afternoon, good morning, good evening, everyone. Welcome to today's Luohan Academy seminar. And I'm Shumiao Ouyang from Oxford Scientific School. And it is a great pleasure to welcome Professor Ricardo Caballero from MIT. Professor Caballero is the fourth international professor of economics at MIT and a research associate at the NBER. He is also a fellow of the Econometric Society and a fellow of the American Academy of Arts and Sciences. His work has made major contributions to macroeconomics and finance. Today's topic, speculative growth and the AI bubble, could not be more timely. AI is reshaping expectations about investments, productivity, and the future of economic growth. It also raises a central question: how should we think about the extraordinary valuations surrounding such a transformative technology? So we're very fortunate to have Professor Caballero with us today to share his latest work and insights on this important topic. And Ricardo, thank you very much for joining us. The floor is yours, and you have 1 hour. And would you like to welcome questions in the process?
Absolutely. I assume that it's going to be seminar style.
Yeah.
And so on. So thank you very much for your kind introduction and for inviting me to this wonderful series. Let me start with a disclaimer, though. I'm not an AI researcher. I'm an AI research consumer. So, but what I am is a macroeconomist, and I think that AI, even the very broad features of AI, have very interesting implications for macroeconomics and finance. And that's what I intend to talk about. So, and it's also a guide of the kind of questions I'm likely to have some value added. My answers are likely to have some value added versus those that are not. So this paper, the motivation of this paper is a series of facts and narratives. It's not a surprise to anyone that those two pictures there, on the left, you have the well-known massive increase in the equity value of companies central to this AI development in all parts of the food chain. And that part of that has come, unlike the dot-com bubble, part of that has come with significant earning growth, very significant earning growth, like companies like NVIDIA. But it's also the case that multiples are very elevated. Certainly, if you look at in terms of backward-looking multiples, they're extremely elevated, record levels, dot-com era type things. When you look at forward-based multiples, they look a lot more decent, but still they're quite elevated. And on the right, you have the companion fact that the investment in everything that is AI related has increased quite massively. In fact, today a big driver of aggregate demand in the U.S. is investment, and is particularly investment in all that is related to the AI cycle. Data centers, for example, were totally irrelevant from the point of view of aggregate investment just a few years back, and now they're projected to account for more than 1.5% of U.S. GDP. That's a major contribution to aggregate demand, but also to the addition of the stock of capital. So in that context, it's not very surprising that there has been lots of uncertainty and narratives around whether this phenomenon is justified or not. And the discussion is typically framed in a very binary terms. Either they reflect fundamentals, so either these valuations reflect fundamental, or they reflect a bubble. The fundamental view, it's, well, elevated valuations are there because, the future is wonderful, and the investment is fully justified. It's the way of implementing that future. And all this discussion of fragility is really just noise that happens along the transition. The polar opposite view, is the bubble view, in which valuations, the view is that valuations, yes, this may be wonderful, but valuations have become decoupled from fundamentals, and a correction is inevitable. So the main point of this paper is that perhaps I wouldn't say the main point, but the starting point of this paper is that this distinction is too rigid. Okay, I'm going to produce a model in which along one equilibrium path, and the emphasis in one is important because there's more than one, elevated valuations are consistent with fundamentals and support the accumulation. And but yet, and that's the bubble part, and that's a quote around bubble in my title, that trajectory is fragile, and because it depends on agents coordinating in some high valuation equilibrium. So again, the quotes comes from, remember my title, Speculative Growth and the AI bubble. Bubble had a couple of quotes. Well, the quote is because there is a path in which it's not a bubble, but you know, if things crashes, we're all going to be talking bubble, and it is very possible that it crashes. So, you know, the usual question when you think about bubbles and is are valuation justified by future fundamentals? Another way of thinking about the question this paper is asking is, can valuations help create the future fundamentals that justify them? Okay, so it's a bit of reverse causality. And the idea is, you know, when investment respond to asset prices, valuations are not merely a reflection of expected fundamentals, they can be part of a mechanism that produce those fundamentals. But this in itself makes the whole equilibrium fragile because you need these high valuations to produce the fundamentals that justify the high valuation itself. So you can see the circular nature of the argument and how things can in principle go wrong. So bottom line, and I'm going to get now into the mechanism and so on, is I think the distinction between fundamentals and bubble is too rigid when investment is so valuation sensitive, and I think that's certainly the case in the current environment. So let me try to explain. It's not going to be a presentation intensive in equations, but I'm going to have more equations, a little more later on. But let me try to explain the mechanism before we get into the details. So in this mode, what will happen is that high valuations can be self-validating if they support enough investment to the transition, and the and is key here. That's the reason I have it in red. If the eventual high capital economy can be funded, you want to have an equilibrium where capital is very high, mostly AI capital, but also conventional capital. But to fund an equilibrium like that, you're going to need sort of lots of savings. And also very low interest rate to be able to support that high capital. So the key ingredient here is that this process of speculative growth can produce conditions on the funding side that delivers lower interest rates in the high capital equilibrium. Okay, and so what will happen in this economy, I'm going to show you how you can generate that. You're going to get in the good path, in the speculative growth path, you're going to get into a situation where increasing valuations, Q for me is going to be valuation, it's a Tobin's Q, meaning so value of installed capital versus replacement capital. To me, that's a proxy for valuation here. So an increasing in valuations will increase investment, the investment will increase AI capital, and AI capital actually will have two important features, which is that AI capital is very labor-like, so it's going to effectively increase the effective supply of labor. That will preserve the high marginal product of capital, which sort of is the dividend side of the valuation equation. And then because a significant share of that income that comes from AI capital goes to capital, that increases capital wealth, that will increase the saving rate, will reduce interest rate, and that further validates the high valuation. And so that's going to be the story. Now, in that equilibrium path, that successful equilibrium path without a crash, the model will generate some interesting features. And so the first feature you're going to see is that one of the features you're going to see is that high valuations will peak mid-transition. So you're going to see a phase in which valuations are very high, they keep rising for a while, and then they begin to converge smoothly towards normal valuations. That's in the good path. Again, things could crash in between. I'll talk more about that later on. Also, I think is very interesting, and particularly interesting for macroeconomists, is that interest rates in this world eventually fall. Okay, and that's going to be a very important driving of the mechanism. You'll see in the transition they need not fall, but eventually they fall, and it's important that at some point markets begin to appreciate that this good equilibrium will deliver a lower interest rate. Another feature will be that it's very common in most models of macro models of AI, especially growth models, is that the labor share will compress here. Okay, as you go into the speculative growth path, then you're going to see a decline in the labor share. And the last feature, which is again the reason there is some bubble talk in this talk, is that there can be crashes even without any changes in fundamentals. You know, if people become pessimistic about the outlook of this AI boom, then things can crash, and you know, and then everything will look exposed like it was a bubble, even though this was just a matter of coordination. So let me continue with the confessions. The mechanism in this paper is not novel. The mechanism in this paper comes from a paper that I wrote with Emmanuel Fari and Mohammed Hammoul several years back, and there it was motivated by the dot-com bubble and crash. And so we started there, and so I think I want to spend some time explaining how that paper worked, and then see how AI fits. So this is a paper. The paper I'm presenting today is a paper I put together quite quickly because, you know, I had these ideas in mind, and then I read a few papers on AI, and I said, whoops, this fits extremely well with the story we once told. And that's the way that yeah, this was an idea last December, and the paper was finished in last December, because a lot of the background work we had already done in this previous paper. So let me explain it. So it was motivated, as I said before, by the 1990s, really. And the 1990s is sort of more or less what matches what we're currently living in this AI boom, I think. There was, you know, the dot-com bubble was emerging. There was an immense investment boom. The economy was growing very fast. And at the same time, which is somewhat paradoxical, interest rates were falling. And in fact, interest rates fell quite a bit. And when you look at the increase in valuations, actually during that period, yes, we had the valuations, very high valuations concentrated in the dot-coms, but it's also, you can account for a big part of the increase in the broad index by these steady declines in interest rates. So there you have this contradiction between, you know, high investment, fast-growing economy, and at the same time, declining long rate in particular. And there is where we came with the insight I already described, which is, you know, you can have, in fact, this may all hangs together because you can make the speculative boom rational if the boom itself generates the funding conditions that will support the high valuations at some point. Okay, and so the speculative growth problem, where the title comes from, is from the fact that optimism itself raises valuation and stimulates investment. The high investment requires both high valuations in a transition, but it also requires funding. And so you need to find a mechanism for why this benign equilibrium will generate enough savings in the future to fund this high capital and investment at low interest rates. In that paper, we were very abstract, and I will show you how abstract we were in a few minutes, but we had in mind some stories, and we told, I think, 4 stories there. 2, which I think were very prominent, are the ones I highlight there at the bottom of the slide. One was fiscal. There's very little of that today, but one was fiscal. And this story had both an exogenous component and an endogenous component. There was an exogenous component because the US went through a process of fiscal consolidation, but also was an endogenous component of the kind I'm describing as above, what I described above, which has to do with, you know, the valuations, high valuations themselves led to a lot of capital gains. The fast growth also led to high increases in revenue, in fiscal revenue, and so we generated a surplus in the process. So the fiscal side was very supportive. We call it surplus illusion because you know, it's a surplus that would occur only if we stay in the good path, because if there was a crash, then you would lose all those high taxation, you would lose the high growth, and then the surplus would not be there. But, and that's important, in the good equilibrium, then you could count with the fiscal side supporting the funding of this investment boom. That was one mechanism. The other mechanism we highlighted at the time, and I think there are some elements of that going on right now, is capital flows, capital inflows into the US. And the capital inflows has a series of reasons, but I think a very important reason was that the rest of the world didn't look as good as the US. So that was sort of a beginning of a US exceptionalism type of story. And it had two kind of flows. First, the equity story in the US looked wonderful. I think that is akin to what is happening today. And second was that, remember, that was post-Asian crisis, emerging market crisis, and the like. So people were also looking for a safe store of value, and US treasuries looked very appetizing to global central banks, sovereign wealth funds, and the like. And so those part, again, that was an exogenous push that helped all this investment boom, but also the story itself sort of made the US look exceptional, and that brought capital inflows, which that is foreign savings was part of this funding mechanism triggered by the good story in the US. And I think, again, that second story in particular is quite relevant today in the US. So let me very briefly describe the CFH model, and I'm going to describe the parts of it that I will need for today's talk. So the model is a diamond OLG model. Diamond means an OLG model with an overlapping generation model with production. That's not important. It's not important that it's an overlapping generation structure. It's just that makes it simpler. It's just a model with production and investment, but in which investment has adjustment cost, and the adjustment cost is what allows Q valuations to be different from steady state valuations, because it's difficult to replicate what is working well. And the third component, which is very central but was very, very abstract in that paper, is the funding function. That is something that, and the particular feature of this funding function that we wanted to highlight was that this funding function depended on the stock of capital itself. Okay, so saving in this economy was a function of the capital stock, and we wanted to prove everything, and linear models are easier to prove than very nonlinear models. We wanted to have an S-shaped saving function, meaning a saving function which was low at low levels, a saving rate that was low at low levels of capital, and then there would be some region where the saving rate would start very, very rapidly before plateauing again. And the easiest way to capture that in a linear model is just to have a jump at some point, and that's what we did. We had a saving function that it had a jump at some level of capital K naught. Okay, and what we show that you do something like that, then you come up with a model in which you have multiple steady states. I mean, you make this nonlinearity sort of large enough, the jump large enough in the saving function, then you can come up with multiple steady states. One steady state in which capital is low, saving is low, the interest rate is high, and then a high steady state where high capital steady state where capital is high, savings is high, and the interest rate is low. And so let's focus on the first panel there, panel A, and what I'm plotting there is let's do the steady state first. We're plotting Q valuations against the capital stock, and and then K naught is the dashed vertical line. That's the point in which the saving jumps when we reach a level of capital, and you can see that model can generate two steady states: a low steady state, which I'm denoting as Kn there, and a high steady state, which I'm denoting as Ks. So that's that, and all these. The three figures share the same, but again, all of them have multiple steady states. And the mechanism is exactly what I said before, is that high capital stock comes with high savings and low interest rates. Now the question, and that's the question that I want to focus here today, is not only whether we can have multiple steady state, but whether we can have multiple equilibria. Okay, and multiple equilibria in particular means here that can it be the case that starting from the low capital equilibrium, the equilibrium there on the left, we can enter into a trajectory that takes us into the high capital equilibrium. Okay, and the idea would be that that's the kind of environment we may be right now, And what happens in that equilibrium is, again, let's focus on the upper left corner, is what you see there. You're starting with low multiples at the low capital state equilibrium. Then somehow we become very optimistic about the future of AI. That makes valuations jump today. Once then you're out of steady state, because with high valuations, firms start investing. So investment starts rising, but as investment rise, valuation keep rising. And at some point, you reach this high level of, you reach a level K naught, and then savings begin to rise a lot. And when savings begins to rise a lot, then the interest rate collapses, and then at that point, actually valuations remain high, but start declining, and you eventually converge back to the high steady state capital equilibrium. And so that's the type of speculative growth dynamics that I have in mind when I say speculative growth. So high valuations that come with rising prices and asset prices that eventually hit the stable manifold, the saddle path of the high steady state equilibrium, and then you go converge smoothly to the high steady state equilibrium. So that's a type of dynamics I'm going to concentrate on during the talk. The other two figures there, I'm not going to explain in great detail, but it says essentially, I need special conditions for the first panel to occur, and in particular, what I need is that adjustment costs not be too low or too high. I need adjustment costs that are not too low, because otherwise capital moves too quick relative to valuations, and you cannot, that's panel B, and then you cannot hit this when you are in the low saving phase, which is the phase to the left of K0, valuation rises too much relative to capital stock, and then when saving rises a lot, then the equilibrium asset price is much lower, and therefore the unstable arm of the lowest steady state equilibrium cannot hit the saddle path of the high capital equilibrium. And when the adjustment cost is too high, then valuations have to rise too much to increase the capital stock enough, so you trigger the good savings dynamics, and therefore you also miss the saddle path equilibrium. Again, all these are interesting curiosities. I'm going to just focus on equilibria of the kind in panel A. So there's nothing of AI in what I've been describing here, and all this is very abstract, because the saving function with a jump is a little strange. So what AI will do for us today is will make all this more natural. And that was my aha moment, in December. Oh, I always liked the title of the paper we had with Emmanuel and Mohammed. I never liked the model. And AI, from my side, gave me the opportunity actually to come up with a story that I think fits the model quite nicely. So what is the special of AI in my view? I think AI is a singularly powerful application of the principle, because with one primitive, that is that the feature of AI capital is that it's very much labor-like. It substitutes for tasks that workers do. You naturally generate the two ingredients that facilitate the speculative growth equilibrium. It has a productivity side, and it has a funding side. They're all built in from one feature, and that I like a lot. It's a very parsimonious mechanism. Let me explain this before I go into the equation. So on one end, the fact that AI is labor-like facilitates multiple equilibrium, because one of the things that kills multiple equilibria sort of in any neoclassical growth model for example, is that if you want to have more capital, the marginal product is declining. So the dividend associated with more capital declines with the stock of capital. And that's a force that makes it very unlikely that you have a second equilibrium, because decreasing returns does not let you have a lot of capital. Well, if it turns out that you can create capital that acts like labor, then the marginal product of capital really doesn't decline, because it becomes a linear function. You can, every time you increase capital, you increase the effective workers, and therefore marginal product of capital doesn't decline. And that allows you to consider sort of a range of equilibrium in capital space. And on the funding leg, it also comes from the same ingredient, because this labor-like feature of AI means that income that would have gone to labor in a standard neoclassical model of growth goes to capital here, because it's the owner of that AI capital that behaves as labor that earned that part of the labor, of the old-fashioned labor share. And that means a disproportionate share of the earnings from this investment and the profits from this investment is allocated to capital owners. And capital owners, there's substantial evidence that the rich tends to save more as they become richer. And that's going to be the mechanism that will lead to the funding feedback. I don't know how much time I have. I do not know, but please let me know if I'm wrong, of papers that compete with this one, except for the paper that I described before. But there are lots of papers, but the ingredients that I have in each of the parts of the models are not really novel. On the technology primitives, there's a very extensive literature that that describes AI as robots, that can automate workers' task. So A as labor. Again, I have a few references there, but it's a very large literature. There is a smaller literature, but that also documents that AI adoption displays J-curve type implementation friction. That's to motivate the adjustment cost I'm going to have in the model. It's difficult to generate lots of profits out of initial. There's a learning curve and so on. So there's an adjustment cost process in making AI productive. On the funded feedback that will be very central, I'm going to rely a lot in the background. My model is going to be a little different in the background, and work that Ludwig Strauss did a few years back in his thesis at MIT, actually, and in essentially documenting and modeling how wealth concentration can lead to higher saving rates in an economy. And then the fourth block of papers I want to cite, one of them actually I think was presented here by the Andrews and Parbodi paper, is papers that are beginning to document the implications of AI for asset prices and rates and interest rates, which are consistent with, I think, with some of the implications that will come up from this model. The Andrews and Parbodi paper that was presented in this series, actually, it's quite interesting, because it shows that any good news about the pace of AI adoption or the pace of AI news, or the pace of AI success, leads to lower interest rates, which is quite interesting, I think. You'll see why I find that quite interesting. Again, so I think of this paper, this very vast literature, as supporting of ingredients more than as papers that do the same. So let me get into the meat of the model. And so let me first describe the technology side, the fact that labor like AI helps with this diminishing returns to capital feature of neoclassical growth models. So let me start with a simple, and this is going to be a totally minimalist model. It's not meant to be realistic. I'm just trying to illustrate a mechanism. So start with a production function, the most basic production function. I call Douglas on production function on conventional capital. The subscript C denotes conventional capital, machines and the like. And N is going to be effective labor, constant returns. Total capital is going to be the sum of conventional capital and AI capital. AI capital, the substance is L because it's labor-like. And effective workers is going to be equal to the labor supply, which I'm going to assume fixed at 1 here, plus labor-like contribution from AI capital. And I'm going to assume that 1 unit of AI capital is equivalent to gamma workers. So gamma denotes the productivity of AI capital in terms of units of workers. And another feature that will be important here is that there will be some sense of congestion. Okay, so you can replace tasks with tasks done by workers with AI, but not all of them. At some point, it gets very complex, and there is decreasing returns kicks in. There is again a literature within the AI in growth models that talks about bottlenecks and things of that kind. I'm trying to capture that in the very minimalist sense. So there's a range in which you can substitute workers with capital so I'm doing it in a very stark version. There's a range where you can substitute workers with AI capital, but beyond that point K bar, that's no longer possible. And therefore the effective labor force is fixed once we reach that level. Okay, and then once effective labor is fixed, then decreasing returns kicks in again. So that leads to 3 regions. There's a very conventional region where K is below KAI. KAI is the point at which you start investing using capital for AI. And so there is region 1. There's no AI capital, and the return for capital is just a standard decreasing returns of a Cobb-Douglas production function. There will be, in that region, what sets the boundary of that region? Well, the point in which using capital for AI purposes to replace workers or for conventional uses has the same return. Within region 1, using capital for traditional things that capital does has a higher return than using it for substitution of labor. Then there's this intermediate region, which is between that point in which the 2 uses of capital become for the first time equalized, and the saturation point, that is the maximum use of AI capital as a substitute for workers, in which you have a situation in which the marginal product of the 2 capitals is equalized, and you can see that when you do that, essentially every time you expand capital, you expand AI capital proportionally, which effectively means you are increasing the effective worker supply proportionally, and that means you get constant returns rather than decreasing returns. And so there's a region in which you have constant marginal product of capital because you have constant returns rather than decreasing returns to capital, and the return to capital is just some form there. And then when you hit the saturation point, the K-sat, now at that point, it makes no sense to continue using capital for AI for effective workers substitution, and so the effective labor supply becomes fixed at 1 plus gamma times K bar upper bar L, and then if you add more capital, then decreasing returns kicks in again, and so marginal product of capital is decreasing, and that's exactly what you have in the figure there. You have this decreasing first segment, then flat, and then decreasing. Okay, so that's ingredient 1. The second ingredient is households. So I need to generate savings from this story, and I'm going to split households into 2 groups. There's going to be workers, and workers are going to be hand to mouth. So they're not going to save; they're going to consume all their wages. Okay, so the savers in this economy is going to be the capitalists, the owners of capital, and they're going to maximize lifetime utility over consumption. And the consumption function will have a little twist here, which is these capitalists are going to have low utility with respect to consumption, but they're also going to value having wealth. They just like they like the rich uncle. They like to have wealth for the sake of wealth. It may well be the case that is true, that's the reason the rich save so much, but I'm doing this as a shortcut. There is a micro foundation. The paper by Ludwig, for example, has a micro foundation for why this happened. This is what leads to what is called non-homothetic preferences. I'm going to capture that in a very simple way with the utility function I described there. And the bottom line, all that I need from that, which is what comes there at the bottom, which is the main result in Straub, I would say, is that the consumption function is increasing in wealth, but has at a decreasing rate. Okay, so fee, in any higher utility function, you're going to have that consumption is proportional to wealth in some way. This proportionality factor may be interesting, but it's proportional to wealth. While once you introduce this component, then consumption is the consumption share. The propensity to consume out of wealth is declining with the level of wealth. And the reason this utility generates that is because it's concave in consumption and it's linear in wealth. So the wealth component is becoming increasingly important. The value of having wealth becomes increasingly, in relative terms, becomes increasingly important as wealth rises. And with this, I'm going to get a key property, because 1 minus C over W is the marginal propensity to save out of wealth, and that's going to rise with wealth. And that's exactly what I wanted, because wealth will rise with capital, and that will sort of bring along more savings. And the last piece of the model, it's a very simple model, is quite important here, which is the capital accumulation equation. There's adjustment cost. That's the reason you have this psi. If psi is very high, then adjustment costs are very low. So small deviations of Q from its steady state lead to from 1, leads to high capital accumulation. When the contrary, if it's a crash and valuations is very low, then that leads to capital decumulation. If adjustment cost is very large, then it's very small, and there's very little capital accumulation. There is no multiple equilibria. I'm going to work, as I said before, in some intermediate range. But all that I'm going to use here is the fact that when valuation goes up, there's more capital accumulation. And then the investment problem for a firm is to invest to the point in which it's a dynamic problem, to the point in which the return you're getting out of the dividend yield and capital gains from investing in capital is equal to some required return. And I'm going to talk a lot about that required return in a few minutes. Okay, so that's a standard Q theory. This is the capital you invest in capital, then you get a dividend yield, the marginal product of capital divided by how much you pay for that capital, and then expected capital gain term, which goes up with expected capital appreciation, increase in valuations, and obviously it's reduced by depreciation because you're losing capital along the way. Now, the important question is so here we have, as we increase capital, if we're in region 1, the dividend is going to be declining. But if you're in the flat region, this is going to be constant. That's going to be important. And then when you're again beyond association, beyond association point, this will begin to decline again. So this is going to play an important driver in the story, the fact that it's a constant region at some point. But the other one that is key is what this does with capital. And let me start, it's a trickier concept when you look at out of a steady state, the behavior of R outside the steady state. But in the steady state, which is what I want to focus here, you have a downward sloping curve. You can show that the consumption function I described in the previous slide at the steady state has this feature, which is exactly the feature I want, because I want the interest rate to be decreasing on wealth, and wealth happens to be equal to the value of capital, the price of capital, the multiple here, times the stock of capital. So if the stock of capital grows, wealth goes up, and this required interest rate declines. And that's going to be very important for the story. We're going to have the funding feedback will come from capital goes up, wealth goes up, savings goes up, interest rate comes down, asset prices are supported because, well, I'm going to get into this guy, it's going to be declining as capital increases, and that's going to support asset prices. I see questions in the chat. You can interrupt me if there are clarifying questions. Sorry, Shumiao, can I let you?
Yeah, sure. If there are any questions in the chat, I will let you know. So
okay, again, because
I have a clarifying question, Ricardo.
Yeah, please.
How does the story work in open economy when maybe you can when return to capital gets fixed?
When return of capital gets, well, first of all, this is the US, so there's always an element of closed economy here, and I would argue that so you could think of this as a model of a global economy, but in which the US has enormous comparative advantage in this sector, so I don't see it as modified by the fact that it's open. I would argue though that it's what I said earlier with respect to the CFH paper is that the funding part gets facilitated by the fact that the US experiences large capital inflows. Okay, and so the fact that the story looks so attractive in the US facilitates capital inflows, and that makes this funding mechanism even easier, I would argue. So for an economy like the US, being an open economy is better than in a closed economy.
Okay. But
let me say that if you're in a small economy, it's still the case that a small economy helps you more than an open economy in the conventional mode, because you don't have decreasing, you don't have no, I take that back, actually, that's convoluted. No, I keep it. So for the US is a large economy, it's a very attractive economy, it's better that it's in a closed economy, that is an open economy. Otherwise, all the funding would have to be done domestically, and therefore all the funding would come from the rich people in the US, and that's more demanding than when it's coming from all the rich people around the world. There was a second question.
Yeah, so there's a question in the chat. So whether it is an AI company or a technology company, no matter how the world's political, economic and technological situation change, ultimately, what are the specific criteria for determining when to invest in such companies that will always make the most money the fastest?
Okay, but that's not a clarifying question. Let me just take clarifying questions, and then at the end we can have Q&A. But let me finish with the model. So questions about the model, then let's have them. But let me finish with this. I'm not very far from finishing. So this is the depiction of multiple equilibria. This is the way it can happen. You can have a low state equilibrium. Then this is the required return curve. This is the flat marginal product of capital curve I showed you before. And then you can have a low capital equilibrium and a high capital equilibrium. Okay, let me move quickly. There's also a third equilibrium in the middle, but that's unstable. These are the only ones that are subtle path stable equilibrium here. But the question I want to address is, can elevated valuations coordinate a transition from this equilibrium to that equilibrium? Okay. What I'm plotting here is actually the interest rate and the return to marginal product of capital. So that's what I wanted to describe. So here I have an illustration of the model I have with all the dynamics. This is the Q dot equals 0 equation, which is, when there is no capital appreciation or depreciation, multiples are not changing. And the Q dot equals 0 curve is that one here. This dash line. So that's when capital stock is not rising nor declining. It's when investment is just enough to maintain the existing stock of capital. And this is the low steady state capital. That's the high steady state capital. And so what you see here is an example of a speculative growth path. Here we're sitting in this equilibrium, these valuations. With this valuation, then suddenly we become optimistic about the possibility of going to a world economy with very high capital, with very high implementation of AI. And then asset prices rise. They keep rising for a while. And then eventually, when savings begin to become very abundant, actually asset prices start declining at the time, because required returns start declining, and you convert back to this equilibrium. So this is what I mean by a speculative growth equilibrium. And I would argue that, interpreted from this model, we are transiting along one of these paths. Okay. So it's important that, high valuation is the mechanism. It's not a symptom of a bubbly condition or so on. It's the mechanism by which we can go there. If this asset price doesn't jump here, we never go to that equilibrium. We stay here, around this equilibrium here. So that's very central to this. So it is the high valuations is the thing we need in order to go to that high capital equilibrium. Now, let me say this very quickly. I show you that the interest rate was declining across steady states. During the dynamics, that means when we're not in a steady state, when we're in this transition, interest rate does not decline monotonically with increasing capital, with increasing wealth. And the reason that happens is because earlier in the transition, you also have much more demand for capital because you need to invest. And so there's an investment boom early on, and that investment boom means that output hasn't increased yet because the capital stock hasn't increased by a lot, but you need to invest more. That means consumption cannot jump. And since consumption cannot jump, it has to catch up from behind. That means consumption has to grow over time. But if consumption has to grow over time, the only way you induce that is by increasing interest rate. So during the transition, actually, interest rate do not, even though interest rate eventually will decline, interest rate remain high for quite some time. Okay? And this is what I'm illustrating here. Here is the time path. So I'm trying to illustrate the path of macro variables when we jump into this process and we go into a speculative growth path. And that's what you get here. Interest rates initially do not decline. They stay high for a while. And then eventually, when the dynamics of people needing to invest in wanting to save more, there is a decline in required returns, which means a decline in the interest rate. So that's the path, and you end up in a much lower interest rate. Now, also along the path, what you see is that you start from some labor share, and then eventually, when capital it begins to be used for AI purposes, and the labor share starts declining because there's a lot of output expansion is happening just by using capital as workers. So part of the conventional labor share in the Douglas production function is now being taken up by capital. So the labor share in this economy starts declining until you reach satiation levels, and then it stabilizes, but it stabilizes at a lower level. The wage, actually, which is behind this, is you can see it when it's in this region, the wage is rising because conventional capital is expanding, and still you cannot use AI for labor substitution, so that raises the wage. At some point, when you start using capital as workers, then the wage stagnates because capital is spinning down. Every time that the wage wants to go up, then there's more investment in AI capital, and that brings the effective wage down. And so that stabilizes. The reason the labor share is declining here is precisely because the wage cannot rise, but output is rising because capital is accumulating, so the labor share is falling. And then eventually when we reach decreasing returns, then not the labor share, the wage starts rising again. Okay, so that's the dynamics of the wage. I would argue that we're probably around here, and that's the reason we talk about the K-shaped economy and things like that. We may well be in a phase like that. Investment picks up when initially, and then it starts accelerating a lot, and eventually it peaks and it starts declining and goes. This is the investment rate. So the investment level will always be higher relative to GDP in the high capital equilibrium, because capital over output will rise in the steady state, but the investment rate will go back to the old level. And you can make the case that that we see elements of all these things happening today. We haven't yet seen any elements of interest rates doing this. I think we're still in this phase, and I will say a little more later on. Actually, I want to say that a little on. Why don't I think we see elements of this yet today? Well, it's because we are in a phase like this. And this is a very neoclassical model, no? And we're in the phase in which investment is very high, and so that's keeping interest rate high. We have other sources, more conventional aggregate demand sources keeping interest rate high, large fiscal deficits, for example. But I would also point to another piece of research I've done, perhaps my main area of research at this time, is a more new Keynesian aspect, which is that, all this AI investment will lead to future productivity, but the increase in productivity that comes from AI is still very small. And so potential output hasn't risen yet to the extent that we expect it to rise in the future, but the wealth created by this expectation of a great future is already happening. That's what is behind the valuation of the companies and the like. And in a new Keynesian model, that increasing wealth today increases aggregate demand, but since potential output hasn't increased, then you have a mismatch between aggregate demand and potential output, and therefore the central bank needs to keep interest rate high in order to contain a bit this big expansion in aggregate demand. And I think that's where we are at this moment. We have sort of all the elements of aggregate demand very front-loaded, and the aggregate supply processes are much more gradual and it's related to things that will happen in the future. Having said that, there is this very intriguing evidence that I mentioned before, the Andrews-Farbodi evidence, that whenever there's evidence that the pace of the AI process is accelerating, medium-term interest rates tend to fall. It is at a high frequency. I don't think this is because markets understand the mechanism I'm describing right here, but I think suspect it has to do more with fiscal sustainability issues. But at some point, I think these type of forces are going to be more visible. Now, the point that also I highlighted at the beginning, and why the word bubble belongs here, is that this is a multiple equilibrium story. I mean, we may well be transiting along this very nice story, and then the whole issue becomes a little shaky. We begin to doubt the future of AI and so on. And then you can get a market crash. That's a market crash. And once you get a market crash, remember that investment is responsive to valuations. So then investment slows down dramatically, and when investment slows down dramatically, the capital stock sort of starts declining, valuations keep declining, and you converge back to this back equilibrium. So if this were to happen, we will be talking in the future about the AI bubble. Okay, but it's not a bubble in the sense that it could have well been, had we remain optimistic, that we could have generated the fundamentals that did justify all those high valuations. So not a bubble, but fragile. I have only. Let me very quickly say this, so I leave some time for a few questions. So, what can derail this? Aside from just that we all become one day wake up moody and decide to sell the equity market, and we generate a crash and the like. But what could be derail the possibility of a speculative growth path? And I think there's three factors that are worth highlighting. One, the most obvious is, well, AI productivity disappoints. It turns out that gamma wasn't that high after all, that we're not going to be able to substitute workers in so many tasks very effectively. That would definitely destroy the story. The second one, which concerns me quite a bit, I'm quite optimistic about one, but the second one that concerns me quite a bit is, remember, we need a funding leg. But the funding leg could crash. For example, fiscal deficits could creep up, and that would choke some of the funding that we need. Geopolitical shocks of a different type that lead one way or the other to also larger funding needs. Or it could well be that since this funding leg depends so much on the capital becoming so rich, then that could lead to political issues that would limit the ability to fund this. I read today in the Financial Times that some advisor in South Korea had suggested that the entire population should get an AI dividend or something like that, and that immediately led to a little crash in Samsung and relatives. So that could happen. We could see lots of political unrest that limits that possibility of seeing all this enormous growth in wealth. And the other one, which is also a concern, is that creative destruction is too fast. What happens if competition in AI leaves investment in AI very obsolete very quickly, then that can discourage investment and require investment. So that's the first type of story. If AI disappoints, then this curve sort of can shift down, and then you lose the good equilibrium, and you're only left with the bad equilibrium. Of course, there's an alternative story, and I think we eventually will get there, which is that gamma keeps rising, and at some point the bad equilibrium disappears, and then you're only left with the good equilibrium. I'm hoping we'll get there at some point. The other type of stories I told you, the fiscal deficits, as well as the higher creative destruction, are situations where this funding curve sort of shift up, and then you again lose this good equilibrium, and you're only left with the low capital equilibrium. So let me close it here. I already sort of described the mechanism. I'm not going to repeat it. I just want to end with a note of caution. This paper is a possibility type argument. No, I didn't do anything empirically or anything. I just wanted to show that there is a rational expectation path, and that we could justify all that is going on. And all that I wanted to do was to isolate a coherent mechanism linking valuations, investment, and interest rate. And the practical implication of that is that, I think markets are not moved by these very ultra-rational backward induction stories. They're moved by a collection of narratives. But what happens, the way to think about how to use a model like this is that over time, the narratives that survive are the narratives that are consistent with this rational or irrational path. There is a path that makes all this possible. We sort of stumble upon it. Stories develop along the path. Some narratives emerge, some narratives destroy, but the ones that eventually survive, which may be very distinct from the mechanism the most, are those narratives that are consistent with the type of movement that the rational narrative is delivering. And that's the way I think about the usefulness of these sort of very stylized models. So let me stop it here.
Yeah, thank you very much, Ricardo, for the excellent presentation. So I have a quick question.
Yeah.
So for the high capital equilibrium, does it always lead to higher social welfare? Because there are more wealth transits to the capitalist.
that definitely will depend on your welfare function, so it depends on your welfare function. And it's obvious that if you but let me say the following: the fact that I want to show you a picture. The fact that the labor share is declining doesn't mean that consumption of workers is declining. Okay, because the wage is rising here, stays constant. It's just not rising as much as and then it rises again. So wages at the end will be higher as a result of all this AI boostment. What happens is that the distribution of income will be bad. So if you have any criterion, welfare criterion, where the distribution itself matters, that's going to look bad. But if you are sort of just look at, consumption of the workers, that will go up. The issue is more what happens in transition. So in this model, everyone will have a higher income eventually. The issue whether it's efficient or not efficient depends a lot on, more conventional things for conventional utility functions, on whether they sacrifice all the investment that you need to do in the transition, sacrifice too much consumption in the present relative to the future, and things of that kind. But so the only thing that is interesting from the welfare point of view here is simply that even though this is great for capitalists, that does not imply that workers on aggregate need to lose. It's just they lose in relative terms.
Yeah, that sounds great. So so long.
Yeah, I have a couple of questions. Hi, Ricardo.
Hi.
This is Long Chen from Luohan Academy. So I have a couple of questions. I'm trying to understand how we can use your stylized model to kind of interpret or predict things. Now, my first question is regarding how do we define elevated valuation? So now, I think what is happening is not high valuation from the asset valuation point of view. If you look at the, for example, price-earning ratio or whatever it is, they actually, even for the Magnificent Seven, it's actually lower than previously. So what's happening is that they make a lot of money. So their earnings grows even faster than the rise of the capital market cap. So as a result, the price earning ratio is going down. So what I think what's really happening is that it's only a small number of firms right now are benefiting from this, because it's like they need a high requirement for the investment and for threshold for that. So a small number of firms that capture a chunk of this gain at this point. And also, so I'm not sure this is a bubble, nor I'm not sure this will crash, because the fundamental looks good. So you actually make an unprecedented amount of money. So that's one thing I would like to see. How to define this? Is this a bubble or not? Or will this crash? So that's the first question.
Can we go one at a time? Because so I remember. Well, the first point you made, I made it in the introduction, meaning if you look at historical things, CAPE, the Schiller type of statistics, yes, it looks bad because, valuations are high relative to historical things. If you look forward, they don't look as bad. In the model, that's exactly what happens in the speculative growth path. It's exactly what happens in the speculative growth path, because in the speculative growth path, it's not a bubble. That was the point of the paper. That's the reason the quotes I put around. It's the high valuations are justified. And so that's completely consistent with the model. The point...
No, it's not, I'm sorry. It's not just about that looking forward is justified. It's that their price earning ratio is lower than 2 or 3 years ago. So that's because they make a lot of money already.
But that will be happening in this model. That will be happening. It will be happening in this model.
Okay.
Because as you're moving in this direction, your price is going high, but your earnings are going a lot. Remember, you're getting, the labor share and your share here. So companies are doing a lot. So that's one. So in this model, it's very stylized. What you just described will be happening. Earning will be rising a lot, and so on. Now, there is a second aspect of what you said that this model doesn't have, which is that there is a sequence also. Not all companies are alike. There's the adopters, and this model is a lot about the adopters, and then there is also the ones that produce the inputs for that adoption. So the ones that are behind the gamma creation itself. and I think that's a richness that this model doesn't have. So I put them all together, but I don't have. So I agree with that part of the implication, is that the food chain is more complicated, and most of the high valuation is being captured in the very early part of the food chain. But at the aggregate level, this is consistent with what your description of events. The point of the bubble is that if for some reason, all of a sudden we think that somehow this is not going to work out as we think it's going to work out, then asset prices will crash in even the Magnificent Seven, and then the investment won't be as justified, and then the whole thing starts going backwards. That's the bubble light, but it doesn't need to happen. It's a multiplicity type argument. But the stories are consistent. But the other thing I think is interesting is that again, there's a change process here, and I think gamma itself is endogenous, and a lot of what the economic growth idea is about this gamma, but this model doesn't have that.
Well, I just want to say that this is a little bit different from previous bubble or quote bubble. Is that previously they make money much slower than the expectation, but this time they already make a lot of money. So I think it's a little bit different. But but my final question is: would your model predict in equilibrium a higher capital to labor ratio, or it's not?
Yes,
it is.
Yes, because in the model, remember, true labor is fixed,
right?
And you have higher capital here, so capital labor ratio will go up. What happens is a big part of capital will be used as, because you can think of this as the following. You start from some capital labor ratio. Now you keep increasing conventional capital, then you add AI capital, and then as you add AI capital, you add even more conventional capital because it's as if you had more workers, so you can put more argument. So yeah, you end up with a much higher capital labor ratio, and that's the reason you need a lot of funding, because to support all that capital, eventually you need to have a lot of funding, and it's precisely because of that. It's because you need to support that much bigger stock of capital.
So this is very different, because in the past, let's say 100 years or so, actually the capital labor ratio is somewhat stable. But now this time, definitely we'll see a higher capital labor ratio.
Oh,
that's the prediction.
No, I mean, the capital labor ratio has been rising forever. You mean the capital share?
The capital share, yes.
Yeah. No, that's okay. That's that's the question I have here. So here, this is the labor share. The capital share is 1 minus this. And so you're right. That's sort of conventional use. So that's, some people say, well, we're very close to a Cobb Douglas because the labor share hasn't changed very much in a very long period of time. But here, precisely because of the nature of the labor-like nature of this AI capital, you're going to see the labor share declining and eventually stabilize at a lower level. And I mean, we're beginning to see evidence of that. And this is also what might create lots of, political unrest. Yeah. And
it doesn't look like there's even an equilibrium. Is that true? Because you're going to have more and more robots, and look like the labor share is going down. There's no equilibrium to talk about.
No.
Say that without the political interference.
No, you mean what happens if there is political interference somewhere in the middle? That's what I was trying. This is equilibrium, but you could add, suppose you put a constraint that says look, you can reach this labor share because you get a revolution. So you cannot reach any level below that. So how would you do it? Well, then you have to increase taxes. You do massive redistribution. What will that do? Well, that's what I was trying to talk about here. Well, that means that, you're not going to get all the funding for this. And if you have a lot of that, it may well be the case that you lose a good equilibrium.
Got it. Okay.
That's it.
Thank you.
Yeah, it's a little distressing, but in a sense, at this moment, sort of, you want to, there's this wonderful opportunity, and so you want this wonderful opportunity to be able to be funded, then that has implications that may be difficult for society to accept.
So I think my one final, only one recommendation is that you probably can describe some of the facts, things are happening or stuff better, and so make your prediction or interpretation sharper. It's more right now. It's more a bit like theoretical. So the empirical description is too vague.
It's entirely theoretical, but deliberately so. Again, what I say is, I have.
You can motivate us a little bit better, so we can use it a little bit better. Yeah, that's just minor recommendation.
Yeah. But I agree with it. But again, I wanted to illustrate the possibility because it's based on research I've done in the past, but I said, well, this is a wonderful opportunity. But there's lots of empirical projects. I'm not sure I'm the one that will do that, but I see people working on the side. There's a lot of work on the gamma question. There's much less work on there's a lot of work on the ingredients that this model has. And the ingredients are very consistent. That's what I try to summarize in the review of the literature. Whether the implications hold up or not, to me, what I'm really watching is interest rate. That's what I'm going to be watching very clearly, the path of interest rates. Whether at some point I begin to see any chance of real interest rate going down a lot. Otherwise, I find it very difficult to sustain a very high capital equilibrium.
I see. Thank you.
Very good.
Okay, so any more questions? Yeah, so we're already about 12 minutes late. So if there are no questions, probably that's the end of the webinar. Thank you very much, Ricardo, for the talk.
Thank you. Thank you for inviting me.
Thank you, Ricardo. Bye.